All right, with that, for some more insight on early morning trading, let's bring in Keith Fitz-Gerald, Chief Investment Officer at Fitz-Gerald Group. Keith, just want to get your take on kind of the early morning optimism that we're seeing today. And I say that in light of yesterday. We had a pretty kind of first half of the session. We were in the green. Dow was up notably, but then pulled back. So there is volatility throughout these sessions. But so far, what do you think is causing the optimism we're seeing right now?
Well, today, I think it's very normal. You want psychology to move forward. People aspire to do better. They aspire to have a better life, and they want to look into it. So I think the computers are duking it out. They're setting up for a rebound. The markets were terribly oversold. But the danger here is short-term FOMO versus long-term investing. That's the decision that investors are going to be faced with today, because it'll be very, very tempting to run in on what could be a lower inflation rate, what could be a Fed that remains dovish, what could be a breakthrough in Ukraine. All those things are could be, would be, but not should be.
You brought up the Fed meeting, so I want to go there really quickly because that's something that investors are obviously keeping a close eye out for today, right? That meeting starting today. And I think the general consensus is almost assured that the Fed's going to see a 0.25% rate hike. But outside this kind of next rate hike, what do you think investors are most looking for when it comes to the Fed? And what's the biggest challenges that you think the Fed is dealing with in this meeting?
Well, I got to tell you, let's tackle that reverse. I think the biggest challenge is the Fed has got to do something. I think they're acutely aware of that. I don't agree with even a dime of their policy, but the fact of the matter is they know that they've got to take action. The problem that most investors are facing is they want some sort of consistency. I don't think most investors I've talked to care exactly whether it's 25, 50, 75. I mean, the numbers are going to work themselves out eventually. There's going to be pain no matter how they cut it. But they just want the certainty and the clarity. That's the thing that I hear time and time again from investors around the world. I want certainty and I want clarity, and I don't care how I get it. I just want it.
In terms of certainty and clarity, obviously investors are looking to try to get some sort of signal, some sort of indication on what the Fed's future kind of plan is, how many rate hikes we could see, and certainly how aggressive those hikes could be. In the general sense, because I don't know that the Fed is going to fully be transparent there, especially not the way they were transparent about this 0.25% rate hike. In the general sense, is there a concern, given everything that the Fed has to tackle right now and kind of put into the pool of information to make a decision, is there a concern that the Fed perhaps can be too dovish this year and lead to stagflation here in the U.S. economy, or the Fed could be too aggressive and we get into recession territory?
Well, I tell you what, in my mind, both of those possibilities are very real. I think the Fed missed this crisis in formation. They certainly didn't get transitory right. That's going to go down as one of the greatest mistakes of modern financial policy when the history books are written. So to me, going forward, they've clearly got to get the recipe just right. And the challenges with doing that are extraordinary.
Obviously, interest rate hikes expected, right? We know a 0.25% basis point, most likely after this meeting. But with that, it's going to mean the consumer is going to pay, not only higher prices at the gas pump, but for things like an auto loan, the price of a mortgage, obviously that's going to go higher. What's the concern about consumer spending pulling back, pretty dramatically? And I guess that point a moment ago, that's the concern around a recession.
Well, I think that is the concern, because mortgage rate, credit card rates, personal loan rates, anything that's got to do with the flow of money is going to get more expensive. So raising rates into this storm, arguably, theoretically, is exactly what should happen. It should probably be far more aggressive than 25 basis points, in my humble opinion. But the consequences of that are going to be catastrophic if they suddenly come out with a 50% or 75% basis point hike over the next 3, 6, 12 months. That's going to bring to mind shades of what was called the bond massacre in 1994, where the markets fell 14% in 14 months as a result of very, very fast interest rate movement under super similar circumstances.
Want to pivot, to oil. Obviously, that's something that has been affecting the markets, certainly even a part of the inflation picture. U.S. oil, though, briefly kind of fell below $100 a barrel on Monday after spiking earlier this month, $130 a barrel for crude. On the tensions with Russia and Ukraine and the geopolitical crisis that is going on there, do you think we could continue to see the price of oil come down? And what does that mean for gas prices?
I hope so, and here's why. The average American consumer, according to data that I've seen recently, is going to pay something on the order of $2,000 and maybe even $2,500 more for gasoline this year because of the fuel cost increase. It's an implied tax on the American people. So if we assume that oil is going to come down, and again, I hope it does as the world relaxes, then that's going to be instantly more money available to American families that need it. It's going to be more money to go into the shopping centers, to get to groceries, to get to medicine, all of the other things that are still very much under inflationary pressure.
You know, something I think more broadly and on the global front, people or investors are kind of keeping an eye on. Obviously, the situation in China, kind of the COVID outbreak there, the zero tolerance policy essentially that China has taken on COVID and leading to lockdowns that are affecting, you know, or will affect supply chains. But I think potentially even concern in other parts of the world that we could see another spread. Do you think the market is pricing in any of that concern? You know, I think yesterday we saw more of a pricing in of supply chain concerns.
You know, again, very, very sharp question. I don't know the answer to that one. My guts tell me that the markets have not priced it in yet, just like they didn't price in COVID the first time around, and just like they struggled to come to terms with Omicron and Delta variants. So here's the thing about pandemics and what we know about market history is that the markets eventually learn to deal with the unexpected. So every time we get a new variant, every time we get a new headline, the markets are increasingly taking it in stride. Now, people can assume that that's a source of fear, things are going to get bad, but I look at that as reverse, because what we know is that as the markets adapt to that, in fact, the world's best companies are going to continue to move forward. The world's best CEOs are going to continue to plot a course through that. Politics, not so much. Infectious diseases may be debatable, but again, the money is going to move forward. The markets are going to move forward. That, to me, is reassuring, just as the case is going to be here going next 6 months, I think.
So given this full picture, right, we still have lingering COVID concerns, albeit lesser than probably, you know, a year or so ago. We have a high inflation kind of, you know, concerns and pressure there. And then we have these interest rate hikes that are looming, you know, one kind of being imminent at least. With all of that in context, what are kind of the smartest investments to you, you know, in terms of making right now? What industries look attractive?
Well, I'll tell you, you've got to make a decision. Do you want to hunker down and pretend that none of this is happening and just go away somewhere to a quiet place in the woods and forget it's all going on around you? Or do you want to invest as if there's a tomorrow? I'm an optimist. I will assume that there is going to be a tomorrow, and I'm going to invest into it. To me, right now, some of the great choices are going to continue to be energy, because we're going to need it for the foreseeable future, regardless of whether it's dinosaur juice or electric power. To me, big tech is clearly on the radar. It's been beaten down. People have just smashed it to smithereens. But if you've got a 3 to 5 year horizon, companies like Apple and Microsoft are absolutely no-brainers because of the impact that they're having on the world. A company like Peloton, which has been beaten down, arguably not so much, because it's a nice to have as opposed to a must to have.
As soon as you mentioned Peloton, I was wondering where were you going there, because that is one that has been, you know, a pandemic darling that has certainly fallen from grace. Keith, really appreciate your insight. Keith Fitz-Gerald, Chief Investment Officer at Fitz-Gerald Group.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.